I truly believe that the owner-occupiers is what drives real growth. This is the last time they can actually help first-time buyers to get into the market, because now the market is going to go at a median price of over $1 million and no one would talk about anything under $1 million, right? I think people are still waiting for APRA signal to come back. First home guarantee scheme, 5% deposit scheme, no servicing caps, no income caps. Yeah, this is the beautiful era. Hello and welcome to another episode of Help Me Buy Property podcast. In today's episode, we'll discuss RBA, who has already done a rate cut, and what are the implications. We'll talk about the history-changing parliamentary discussions around the 5% deposit scheme, the first home guarantee scheme, and how is market going to pivot from this point forward. 2025, 2026 is going to be a game changer for a lot of investors, for a lot of owner-occupier who are trying to enter into the market. For this episode, I have our residential property expert, Mr. John Lindeman. John, how are you today? Thank you for coming back on the show.
It's a pleasure, Moss. I'm very good, and I hope you are all as well. It's certainly very good news that we're hearing as far as property investors go. Yes.
So if we take a step back and talk a bit about this, that last time when we caught up, we knew that RBA hadn't done the rate cut. We were still contemplating whether they would or they would not. And we knew for a fact that RBA has to, at some given point in time, do a rate cut, because if they don't, they keep backing themselves in a corner for a higher or a deeper cut as well. So talk to me about where your understanding sits and how this is going to play out over the next sort of 6 to 12 months.
So we'll have a look and see where markets are actually moving at the moment, my forecasts, and of course, I'll give you my boom predictions. And in that regard, of course, Moss, with the National Housing Market Update, the big ticket items, interest rates falling, and the first home guarantee scheme rollout has been brought forward. So it was going to start in January and now starting in October. Massive news for first home buyers. And I think it's going to have a huge impact on property markets, which I'll explain to you a bit more about that as we go on.
Yeah. Over to you. I think I'm intrigued as well. We can jump right into this because, yeah, this is something that I've been following quite religiously as well. First home guarantee scheme, 5% deposit scheme, no servicing caps, no income caps. This is the beautiful era. So yeah,
it is. I think the interesting thing in terms of when you look at it economically, supply and demand, what they're doing is increasing the demand, but they're not doing anything to increase the supply. We've got a national housing shortage, a huge rental shortage. Rents are going up almost everywhere. Prices have been going up. And of course, what they're doing now is fueling the demand, bringing forward the demand. So it's going to have some dramatic effects on the market. And I think in general, my feeling is much more positive than it was a few more months ago. And what I can do is share with you this is the core logic, or totality as they're now called, the data. And I thought it'd be interesting to look back at the last 5 years, because normally I don't really look at past performance, but sometimes, especially with what's been going on with interest rates, it can really give you a good insight as to what to expect. This is the Darwin property market, and you can see that over the year, housing values have gone up by nearly 9%, and quite dramatic there in the last few months, a huge increase in prices. But when we look back there, look at July 20 and that first huge rise there. What followed that was a tremendous fall, and it actually went negative. So when you look at the Darwin market, it's a very small market, only about the whole of Northern Territory, about 150,000. So it's not a lot of households involved in this, and they're nearly all investors that are causing that growth. And so it's a highly volatile market. even though that growth is very strong, it's not likely to last very long, and there's very high risk potential. And I think you agree with me on this score, don't you?
100%. Yes. It's all the investor-led activity, right? And so I truly believe that the owner-occupiers is what drives real growth. A lot of these growth is short-lived, where the investors walk in and out of the markets depending on where the employment and the infrastructure spending is. And if they are not there to stay, the investors would walk out of some of these plays. And it creates that sort of share market mentality, right? Where you're treating assets as an investment class and you're trying to short the market by getting in, making quick bucks and getting out, right? This is not fundamental investing. Basically, that's what I come down to, right?
No, it's what I call speculation. It's very
sad.
Yeah, it can be very dangerous.
Yes.
We look at Canberra, and this is something else I wanted to bring out by looking at the last 5 years. We looked at there's some extraordinary things that happened, of course, during COVID, and that was the dramatic fall in interest rates that occurred, and then the subsequent rise in interest rates. And you can see that Canberra's been doing very little, if anything at all. It's been slightly negative. But look at that. And it's what I call the COVID hump and slump, because this hump and slump was caused purely by the fall in interest rates and the massive rise in interest rates that followed. And every capital city has experienced this to some degree, but the eastern cities like Sydney, Canberra, Melbourne, more than others. And if you want to look at the long-term trend and pick, well, what is likely to happen here, the best thing is just to simply ignore that, just straight line it, and then you can see more clearly if that hadn't have occurred, the rate falls and then the rises, what would the market have done? Probably something like this. And then we can look forward and say, well, in that case, it's probably going to go up a bit. So with Canberra, we're looking at low imminent growth potential. And I think the interest rate falls and the first home guarantee schemes will only serve to increase that demand. But we're not looking at a boom for the Canberra property market, but we're not looking at a crash either. Hobart, again, discount that huge hump and slump and look at the overall trend, and you can see it's been trending down. But again, since the last year or so, it's been going up again a little bit, not a lot. Over the year, dwelling values in Hobart have gone up 2%, and so very, very low growth. But it's positive, and we're not looking at any falls occurring in the Hobart property market as a result. In Perth, it's quite a different outlook altogether. You can see there that it's been falling, but you see, when you look at that fall, all you're looking at there is a decrease in the rate of growth. It's still positive.
Yeah.
Perth is still growing. Over the year, it was 6.5%. The last month, nearly 1%. So it's still going up. It just looks like it's going down. It's not. It's just the rate of growth. And it didn't go negative when the interest rates went up. That market stayed in growth. And so I think what we're going to see in the Perth property market is a turnaround. Growth will probably increase again, mainly because we spoke about the interest rate falls and the first home guarantee scheme. So what we're going to see is the Perth market continuing its growth, although it'll be low to moderate. It's not going to crash.
Yeah,
it's going to continue its trajectory.
Yeah.
Adelaide, much the same. In fact, probably a bit better, because you can see there the decline in growth is not as severe. It's still, well positive, 7% over the last year. And we're likely to see, again, it didn't go negative when interest rates went up. And so we're probably going to see moderate imminent growth potential continuing in Adelaide. Brisbane, even better outlook than that, because again, it's not so volatile. And although it did go negative, the fall in the rate of growth, and remember, this is a fall in the rate of growth, this prices are still going up, and we're looking at moderate imminent growth potential. So overall, Brisbane market should be experiencing a continuing rate of growth, 7 to 10% per annum. Melbourne is the other really interesting one, because over the year, virtually no growth at all. But when you look at that trend, you can see it's starting to trend up, and it's trending up pretty strongly. So even though it went negative and over the last few years prices haven't really gone anywhere, I think that's all about to change, and we're looking for strong imminent growth potential in the Melbourne property market generally. And I'll go into more detail in a few minutes as to where these areas with the greatest potential are likely to be. And lastly, Sydney, again, big slowing down of growth. It went negative after when the interest rates went up, but now it's sort of flatlining. And I think, again, we're looking at low imminent growth potential overall. But when we look at that, we're looking at the whole market. We're not looking at the individual segments of the market like first home buyers, upgraders, downsizers, investors, and so on. So when we look at the forecasts, we're looking more in particular at individual suburbs, how they're going to perform in different types of markets. And to do that, I use my patented housing market prediction solution, and that gives me property data for all 15,000 suburbs, all types of property, snapshot of past performance, the current market, rental yield, cash flow potential, imminent growth potential, and we can predict up to 5 years into the future. Now, all of this, Moss, wouldn't be any good if it didn't work, but we've tested the accuracy, and over 90% in terms of rent movement and price movement prediction. And that's since it was developed in 2011. So that's nearly 15 years of price prediction accuracy. So where would you buy for growth in Sydney? Now, given what we've just talked about, reductions in interest rates, first home guarantee scheme being brought forward, where is the growth going to occur? Where are the people going to buy? And of course, it's going to be in the outer suburban areas, Mount Druitt and Blacktown. The cheaper areas of Sydney, if you can call them cheap, because they're nearly $1 million median price. It's a lot. But nevertheless, those more affordable areas are where the growth is going to occur in Sydney over the next few years.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages, or off-the-plan properties or apartments. Get yourself copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book. It's easy to read. It has a lot of stories. It has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book. What about areas like Central Coast and Penrith and Wollongong? Because they are at the outskirts and people don't really classify them as Sydney. But they are still quite affordable when you compare them to Cabramatta or Liverpool or Bankstown.
Much more so. I can remember when I went to look at buying a house in Sydney when I was 20, and I couldn't afford to buy in Sydney, but a lot of my friends said, we can buy on the Central Coast or even Wollongong and commute to Sydney. So yes, a lot of people do that when prices become unaffordable. We can see with our database exactly the same trends occurring. So it's the more affordable suburbs in Newcastle, Central Coast, Wollongong are all exhibiting the same growth trend. So it's occurring all over.
Yeah. It's quite interesting because, when you talk about Sydney, naturally for owner-occupier, if you're going to come in infill, you're going to start looking at townhouses, etc. One question that I get all the time is, what about apartments in Parramatta or Chatswood or Mossman or Manly? Because naturally people want to live in some of these areas which are a lot more closer to city, where there's a lot more action happening. Apartments have never performed unless they have something like a beach view or some sort of exclusivity to it. Do you think that this is the time where the apartment markets turn or the unit markets turn?
Maybe in Sydney it is, I think. Because housing prices are so unaffordable. And you have to remember that most of the people that live in apartments are renters. So we've got 60-70% of the people living in units are actually renting, so they're investor-owned. So investors are after cash flow and growth potential. But in many cases, the people who these renters are fairly recent arrivals. They've come in from other countries where they're used to living in highly urbanised societies. So they're quite happy to live in places like Parramatta, which are high density and so on. So I don't see that as a downside at all.
Yeah.
And the benefit is, of course, here's location. You can rent in Manly or Parramatta and do so and live in an area that's got all the attractions you want.
There is an interesting trend that I'm looking into Sydney per se, specifically because of the prices of the house prices, is, people are building houses with grannies or flat packs at the back, or they're renting out rooms from within their houses that they have designed in such a way that, they can occupy 3 rooms and 2 rooms while connected to the houses, basically rented out to individuals. I've known of a few clients who are doing this in Sandinwood and Blacktown, and we are designing some of these houses ourselves as well for the Sydney market. And so it's an amazing trend because naturally with the house rules changing about the principal place of residence, where you can, rent out a portion of your house now and still claim the principal place of residence and not exposing yourself to capital gains tax. I see a lot of people going down that path now in order to make it more affordable. And I think that there is a massive play where these people would start paying with emotions because now they think that the affordability has gone up, right?
Yeah, it's quite right. And I think what's behind all this is that massive housing rental shortage that we've got. We're getting so many people coming in from overseas, increasing rent demand. And of course, in response to that, the state governments have relaxed the rules on granny flats so that now in many jurisdictions, as long as the granny flat meets the council guidelines, they can't object to it. So a lot more people are looking at, hang on, this is a good source of extra cash. But it's all come about because of the fact we've got this huge housing shortage. And if anything, the lower interest rates and the first home guarantee scheme will only increase the demand. Let's have a look at on Campbelltown down the bottom. What about Melbourne? Very, very similar situation. When we look at Melbourne, it's all the affordable areas around Melton, Craigieburn, Cranbourne, the Bayside areas around Carrum and so on. Already prices are starting to go up, but there's massive demand, and Geelong as well. So you mentioned areas adjoining capital cities. We can see that the buyer demand in Geelong is lifting quite dramatically, and that's also the case in Bendigo and Ballarat. So all the affordable areas, that's where the growth is being concentrated in both Melbourne and the other regional cities in Victoria. When we look at Brisbane, it's a bit different because there's been a lot of growth over the last few years, and Brisbane, as we know, is now the second dearest city in which to buy property next to Sydney. So it's gone up a lot. Yet there's still more potential in these outlying areas where prices are a little bit cheaper, more affordable, and that's again where these incentives are going to create more buyer demand. So when we look at the price history, that growth is likely to continue. It won't be huge increases in price, but it'll certainly be moderate and quite satisfactory for investors. I think the other interesting thing about Brisbane is because of all this price growth that has been occurring and has sort of moved into the upper socioeconomic areas, what that means is that people are starting to downsize. So when we look at Brisbane and we look at the surrounding areas like southeast Queensland, we can already see a huge increase in demand in places like Hervey Bay, Toowoomba and the Gold Coast. A lot of people are starting to move, downsize, sell a house for $2 million in Brisbane and buy one for something less than that in these regional markets. So there's a lot of potential.
It's quite interesting. Like you can still pick up a house in Toowoomba for under 600,000, or some of the northeast Queensland where you can still buy properties for 500, 550. I think those are the price points that would disappear quite quickly. And as you said when we started the discussion, that the government is bringing the demand up front without solving the supply issue. So it's almost like they are putting the first-home buyers in the firing squad because naturally this is the last time they can actually help first-time buyers to get into the market, because now the market is going to go at a median price of over $1 million, and no one would talk about anything under $1 million, right? Especially in metro areas where people are still keen to buy properties and live there, right? So I almost feel that the government is doing a disservice to first-home buyers by offering them these incentives, because A, you're not solving the supply issues. So naturally, the only place where the demand is going to go is up, which basically prices any future generations out on entering into these markets, even though that there is only 1% and 5% deposit schemes, right? So, yeah.
It's a little bit cynical, I guess. And it does mean if you're in the position to take advantage of these schemes, or, because of the lower interest rate, that you can afford to buy a property, that it really is time to move, because a year from now you'll find that it won't be possible, and prices will have gone up out of the reach of most first-time buyers. So it's an opportunity for some, but as you say, it'll end up being a huge barrier for further first-time buyers. I don't know what else they can do once they've...
I know, right? It's just sad. Like, we've been talking about this for almost a year, or I think more than that, where I've been saying that buying the first home is not the birthright anymore, or would not be the birthright of Australians anymore, of these policies that the governments are introducing, right? This notion of, hey, I want to buy my first home and the government is going to help me, is going to disappear, unfortunately. And some of this real estate would transfer through generations, and it would just be part of generational wealth, and no one would talk about first home buyers in the next sort of 2 to 4 years.
Probably not. And so we look at Adelaide, and again, there's been massive price growth in Adelaide over the last few years, and it's really only those remaining affordable areas around Morford Vale, Mount Barker, and Mount Barker. I picked out Mount Barker because this is an outer suburban area. It's in the Adelaide Hills, a lot of new housing development, but the median price is only around $700,000. So for Adelaide now, that is quite an affordable area in which to buy a home, and that's the sort of area that first-home buyers are moving to, much more attractive than the northern suburbs of Salisbury and Elizabeth, and not too far away from Adelaide, quite an attractive scenic area. So these are the sorts of markets that have got potential. But as we've said, and you've just noted, Moss, that once all those buyers move in, those prices will be well over $800,000-900,000, and first-home buyers won't be able to move in. Also seeing, the same thing occurring with the downsizer market because of the huge price growth. We're now seeing people starting to downsize, relocate as retirees to places like Port Lincoln and the Eyre Peninsula, the Copper Coast of the York Peninsula, and of course the Fleurieu Peninsula around Victor Harbour. And growth is really starting to take off in some of those areas. So again, this is not really for first-home buyers. It's more for investors looking for growth potential. These have got massive potential. And lastly, we've got Perth. Is there anything left in Perth? Well, surprisingly, when we look at our database and we see the impact, again, of the interest rate cuts and the first home guarantee scheme, areas that otherwise would have had no more growth potential, like the outer suburban areas of Perth, and now starting, and even the Armidale and the east, these are the areas that have still got growth potential. Now, the prices are going to go up even more. They're not going to boom, but they're certainly not going to go down either. So growth will continue, and if the areas in which it will be concentrated will be the cheapest, if we can call them that now, or the most affordable areas in Perth. And the same thing is happening there with the downsizers, people who have seen their property prices double and decided to move. They're moving to places like Geraldton, the Margaret River and Albany, where it's a lot more affordable, much more suitable lifestyle for people in retirement. And I didn't put Busselton in there because it's already booming.
Yes.
Yeah, the growth is really taken
crazy. Yes.
So these are the remaining areas. And that's about all I can tell you about the market right now. Is get in quick because it's all going to start to go crazy.
Yeah. Let's bring this together from a user perspective, right? We are talking about, government making changes in helping people buy their first homes, RBA rate cuts. Where do you see the rate cut cycle coming through? Are we expecting more rate cuts coming this side of the year? Are we talking about early next year? Let's give people a bit of perspective around that.
Well, we've had 3 rate cuts this year. And in the August meeting, I just read the minutes. They said in the minutes they expect to have another 2 rate cuts by early 2026. So another 2 to come. That's what they expect, which means here further interest rate falls are coming.
Yeah. One final question, and this is a curveball for you, John. People compare Australian market to New Zealand market, and New Zealand market has been a turmoil, right? It's gone to the lowest of the lowest, massive corrections, massive mortgage sales. Do you think Australia can end up becoming like New Zealand?
No, I don't think so, because firstly, we've got one of the largest population growth rates in the world. We've got massive numbers of people coming in from overseas, and the government's got no intention of stopping that, because it keeps us in economic growth. As long as unemployment stays low, which it's doing, they're going to want more people coming here. Of course, that creates more of a housing shortage, as everyone needs a place to live. So I don't think we can compare ourselves to any other country in the world, quite frankly, because we've got massive population growth, a huge housing shortage, and the sorts of conditions that, when you look back in history, occurred after the Second World War. We had a huge housing shortage, and we had huge numbers of people coming in as immigrants and refugees from other countries. And what that led to was a housing market boom, where after 5 years after the war, housing prices trebled. I don't think that's going to happen here. I don't think they can treble, but certainly they're going to keep on going up. So, we really are if you're an investor or a property owner, it's a very lucky country. But if you're not, it's time to think, well, how can I become one? Because you'll need to do that sooner rather than later.
Yeah. For viewers and listeners who've been sitting on the fence for so long, this is the final ring of the bell before you enter into the ring. I think this is the final signal that everyone could basically send out. I think people are still waiting for APRA signal to come back about, the risk margins, etc. But I think that would be way too late if you end up going down that path. I think this summer is going to be one of the hottest summers for the property market, for investors, for owner-occupiers. So get ready. I don't like calling FOMOs, and I don't like fear of missing out, but I truly believe that 25, 26 would be something that people would look back on and would say that I should have entered into some of these markets, similar to what people have been talking about in COVID, because this is one of those last races where the growth from 26 onwards would be very mature growth, and you would not see some exponential growth coming through.
That's right. I think too, you mentioned APRA, and it's very relevant that APRA's, the buffer rate is now 3%. That's based on the idea that maybe interest rates could go up rather than down to protect people, make sure they can afford the repayments. So your loan is based on a rate which is 3% higher than the actual rate. But if interest rates they've already had 3 drops, we could have another 2. And that would probably motivate APRA to say, well, interest rates are going down, have been going down, therefore we can reduce the buffer rate. So that'll happen probably after the interest rate falls have occurred, which will only add more fuel to the fire, but it'll be too late. Now is the time to get in, not to wait for all that to happen, because when it does, the market will be absolutely red hot.
100%. Well, thank you for sharing the insights, John. Amazing. For viewers and listeners, if you have your own predictions about interest rates and where the market is going, and if you disagree with some of the predictions that we talked about today, please feel free to drop it into the comments below. Thank you for liking our content. If you want to keep supporting us, please hit that like button. Please hit subscribe so that you can keep watching our new content. Thank you for listening to us today. Take care, stay safe, keep smiling, keep investing. This is John and Moss checking out. Adios.
Bye, everyone.